Let's get in a special market voice on the conversation. It's a big day. Abhay Agarwal, MD of Piper Serica Advisors, joins us. Abhay, it's been a really long time, but good talking to you. Looking forward to the conversation. Thank you for taking the time out.
No, thank you. Always a pleasure to talk to you, Neeraj, and to be on the show.
Thank you. Abhay, this morning when we were talking to one sell-side analyst, the belief was that for now, the markets aren't quite pricing in any kind of earnings cuts because of the tariffs, because in most people's views, this will get resolved in a month or two. And if it were to stay for longer, then from the meager expectation that they have, which is Bank of America securities, of 7% and 11% for FY26 and 27, there could be further cuts. I would love to understand how are you approaching the markets currently with your investment thesis, or are you also a bit more cautious because of the tariffs and other uncertainties?
Yeah, Neeraj, I think from whatever we are seeing, and we are seeing some, early pickup in channel orders for the festive seasons, riding on the back of expected GST cuts. So I don't think fundamentally domestic consumption picture has changed. And that gives me the confidence to say that, look, this correction that we are going through, and it will probably continue for a while till investors get their confidence back. But it is again a good opportunity. And it is a moot point to say when and how will the tariff issue get resolved. But let's assume that it continues to stay beyond the next month and month before that, a month after that. There are two things, Neeraj, that make me confident that actually it may be, there are silver linings in that cloud. And the silver lining is the government's focus on driving domestic manufacturing and domestic consumption. And secondly, building alliances with large countries with which we had a difficult relationship. So I think the ultimate outcome, looking beyond next 6 months, next 12 months of these tariffs, is that the Indian economy, Indian manufacturing, Indian consumption will be in a much stronger position than what it is currently now, because the government has no option but to focus on that and boost that. So, definitely there will be earnings cuts, but I think investors, long-term investors, have to look beyond just next 6 months, 12 months. And on the other side, flip side, if the tariff issue is resolved and the momentum to push domestic manufacturing and consumption continues, then I think the market can reverse pretty sharply from that point of time too.
Okay. Abhay, good afternoon. Hiral on this side. We're talking about the entire game in terms of how markets and what markets are pricing in right now. If the tariffs get reversed, say, in the next month or two, what is the fundamental shift that you will expect, number one? And two, which are the sectors would you advise investors to look at, taking into consideration the corrections that have happened so far?
Yeah, good afternoon, Hiral. I think what I would suggest is, and what we are doing is that we are staying with sectors which are already seeing strength, which are kind of benefiting from the tariffs. And I don't think the tariff issue, even though there may be rollbacks, is going to go away, because President Trump still has 4 more years to go. So we will have these bouts of uncertainties regarding tariffs and different things for next 4 years. So markets will learn to live with that. But I think for investors like us, what is very important is to find companies that are using this as an opportunity. So I think the whole EMS basket, and again, these are not my buy recommendations, but these are stocks in our model portfolio, has held up pretty well. You look at companies like Sirma, SGS, Keynes, Amber, Dixon. I think these are the companies that will benefit from domestic manufacturing and domestic consumption. And the second side, we have pharma. Now, pharma generic exports is a space that I don't think will be impacted so much by the tariff situation, because this is a non-discretionary purchase. So we are seeing already slight confidence, cautious optimism by pharma exporters, even in the middle of this tariff discussion. So I think these are the two sectors. And then anything that touches domestic consumption, will be a beneficiary of lower GST, lower income taxes, lower interest rates. So we will see that boost, whether it is autos or real estate, home building, home improvement companies. So I think these are the spaces that investors would do well to stay with rather than looking for rebound plays which may not actually work out.
Okay. Abhay, can silver linings notwithstanding, could it well happen that we may be looking at a flat headline index and specific pockets of strength might continue to do well? Could that be the it has virtually been the template for the last 12 months. Can it last for a lot longer?
No, I completely agree with that. I think, though it's a question, so I would answer by saying that
yes,
I think so. I firmly believe that is happening, that the markets are changing their texture, because for a very long period of time, 60% of India's market cap has been locked in the Nifty 50 stocks. And, you have a bunch of other companies, probably 1,000 of them that represent the remaining 40%. And I think this 40% is now started to express its might, its strength in terms of growth. They're getting access to good management, capital, markets, innovative products. So I am betting that over next 2 years, you will see that 40%, which is outside of the index, grow faster than what the index does. And I think that's where it's very important for investors to be very astute about what are they betting on and not just play the index, only.
Okay. So don't pay the index, which is absolutely correct. And you also mentioned, Abhay, that domestic-oriented sectors is something which probably one can look at right now. So if someone is sitting on dry powder, which sectors would you advise? Because we've been talking about, pharma is something that you already mentioned. A lot of chatter with regards to how the capex cycle plays out as well from here on. Would, the cements or building materials, these be the sectors that you would look at?
Yeah, definitely, Hiral, I would look at them, but I'll caution that some of these subsectors have their own demand and supply equation, which is adverse, which has been adverse for last 4 or 5 years that we have seen. So the capacity has been coming up much faster than demand comes up, and as a result, the pricing power is just not there. So even in building materials, we are seeing that there is kind of overcapacity, cement also, overcapacity for the time being. So my only worry is that though you will see nameplate growth in consumption volumes, the supply side will also grow, so the pricing power may not kick in. So I would stay away right now from cement and capital goods and building materials. But I think other than that, just looking at the whole auto basket, looking at banks that are seeing a price correction right now, looking at insurance companies, that will benefit from GST cuts as long as they retain the ITC with them. So I think there are enough other ways of playing this rather than through cement and building material.
Abhay, just one small subset. It's a very micro one, and a lot of people would have exited it. But this whole gaming thing, what have you made of it? It's being challenged as well as we speak. It's a very small subset. Do you have a view here, or I can ask you something else, by the way?
No, happy to. I'm a keen gamer, but I don't like paying for, or gambling. So I think a lot of this discussion about, whether something is by skill or by chance has been decisively ruled by the Supreme Court. So I don't think there is any point in anybody appealing that. So whatever is a game of chance is banned, and I think that's the way it will be for real money gaming companies. So I don't think there is anything there for investors, frankly, for some time at least.